Catherine, it's great to have you here. Excited to visit with you a little bit more.
Thanks, Leah. Nice to be here.
Well, I think we've been experiencing some weakness in the market, which has been interesting. And there's so many different conversations we can have as it relates to the weakness. It appears that the economy is softening. I'm just kind of curious what your thoughts are on the economy and also maybe what some of your retailers are telling you.
Yeah. So yes, we're finding the same thing, that there is some softening going on in the economy. It's been very subtle as we look through the economic numbers that have been coming out, the employment numbers. This morning we had the ISM numbers come out. We're seeing, not that we're starting to, we've been seeing weakness in the IS numbers there. And the consumer also, consumer sentiment has been down. The retailing in the PCE numbers looked like it was pretty decent. But as we got into earnings season and had the retailers start reporting, we're starting to see a very different story. So most of the retailers actually reported pretty decent numbers, and a lot of that was due to the fact that they managed the expectations of Wall Street. They were very, very lenient with their guidance, and as we got into this quarter, they beat the numbers. But when you really spoke to them, you started to see that the consumer has actually become very, very value conscious, right? We saw it with McDonald's as they're moving more towards the value meal. McDonald's started some loyalty programs. Those are starting to do well. Target, the same thing. Target, home furnishings, apparel, those parts of the store not doing well at all. Best Buy saw it with TVs. People are not buying the high-end TVs as much as they were before. They're looking for more of the value proposition as they go into the store. So a much more discerning consumer out there. Not surprising given what we saw in the August employment numbers. This week, we have our next employment number. So it'll be really interesting to see what we come up with. But I don't think we'll see a huge weakening in the unemployment, but I think we'll again start to see some softening.
Yeah, I think you bring up a really good point. It's interesting. I think after the tariffs were announced, when a lot of the retailers reported, I guess it was their fiscal first quarter numbers, a lot of people took the opportunity to take down numbers or to have very conservative guidance. But it is interesting to see what's happening underneath. And I think even on the upper end, if you look at Sotheby's and some of the other companies, right, they're talking about weakness like in the collectibles market. You've seen art sales really slow considerably, right, and certainly all that reflects a lack of confidence or declining consumer confidence. So I think it's going to be an interesting question about how quickly is the economy slowing.
Right. Well, as you know, when the high-end consumer starts weakening like that, caution, red flags.
Well, what we are seeing we have had a little bit of rotation, which has been good. We've seen financials and oil do relatively well over the last several weeks. We've seen a lot of the growth in tech companies pull back. Where are you seeing opportunities from a sector perspective?
Well, those two of those sectors that you mentioned, energy and financials, are some of the areas that we're really starting to see some good value in. When we look at the financial sector, we've had a lot of momentum in like the JP Morgans of the world, the Goldman Sachs, et cetera. But if you start going down the market cap chain a little bit into some of the regionals, we're starting to see some good value there. Okay, strong dividends, lower PEs. I think if you stay at that upper end where, you look for quality, not so much the really, really tiny ones, but more of the quality names, I think that's a place that's going to be good in the next couple of months. Energy as well. Energy, oil prices have been low, and I think that people tend to stay away from that group because the commodity has been weak. But if you take a look at the companies and what they've done over the past decade, so to speak, I mean, they've become much more fiscally responsible. They're returning cash to shareholders. And I think that's the one area where in 2026 we can get some surprises. So in order to power all this AI, we need energy. So we're going to need oil, we're going to need liquid natural gas. And I think that's a place where we can certainly find value and at the same time get paid to wait, as the dividends are pretty decent.
You also have a little bit of an interesting hedge with geopolitical risk as well, which is
Yeah,
always kind of nice.
right. That's not over yet. So,
Yeah, it's never over.
right.
Now that makes sense, and I think those, in particular, energy has really been kind of an unloved area this week, and I mean this year, and it's been nice to see the strength over the last few weeks. When we had the conflict in the Middle East, we definitely saw what energy, I think, at the most was up 20% for the month. What was that back in June, and then
Yes.
sold off, and it's good to see the strength starting to come back.
Yes, I agree with that. We happen to be overweight the energy sector, so that's
That yeah, and I do think you make a really good point about companies being so much more fiscally responsible and having much more sustained dividends than they did, let's say, 10 years ago.
yes.
Another reason that area might be interesting is if rates start coming down. I mean, I think you might have increased interest in companies that do have yields. And I'm curious, this is obviously a big topic that everybody keeps going back and forth on. What are your thoughts about interest rates?
I do feel certain that we're going to get an interest rate cut in September. So I do definitely think that the short-term rates are coming down. And yes, because we've recently seen that little spike in the commodity price as well, as we got the news from Jackson Hole that Powell seems like he was turning a little more dovish. However, what's really interesting about that, what's going to happen to the long end when the short end comes down? Right. So I think that we'll get some nice rallies in those interest rate sensitive areas like the energy, like the consumer discretionary stocks, all those utilities, anything that's a beneficiary of lower interest rates. But long term, what is going to be the reaction from the bond market?
Yeah. I think it's a very good point. And of course, we've seen the yield curve steepen quite a bit in the last few weeks. And to your point, I mean, that works well for financials, right? Financials should be a
Yes.
direct beneficiary of that activity. But I think you're right. I think you've seen such focus on, is the Fed going to cut in September? Is it going to be in November? When's the Fed going to cut? And the data, I think, at this point supports a cut regardless of when the time is, because the economy is slowing.
Right.
But yeah, I do think the ramifications of what happens with the longer end as we have a larger deficit is something that we haven't really gone through a full realization of yet. I know, exactly, which also would bode well for an environment where balance sheets are more relevant as well, correct?
Correct. That
Yeah.
quality that you and I have spoken about before is definitely going to be important as we get through these markets.
Yeah, I think that's definitely going to be a big theme for sure in the fourth quarter. Yeah, it's going to be interesting to see how it plays out. One thing I was curious about, we're kind of touching on macro risks a little bit, but as you're looking at the cash flows of your companies, and I know you're very bottom up driven when you're
Right.
looking at the sustainability of the cash flows and the dividends themselves. What are some of the biggest risks that you think about from a macro perspective today?
Yeah, I think tariffs is still going to loom, I think. And that's going to play out for quite some time because we still haven't sorted out that whole idea of what's going to happen with the manufacturing, right? So, I mean, there's a reason why the US manufacturing has gone overseas into some of these, lesser developed countries, right? It's because the labor was cheap. If we start bringing that back home again, labor costs are going to rise, right? Labor costs will impact, profits. Profits impact cash flow. So that whole supply of labor combined with the tariffs is something that we're really honing in on. Hopefully, I mean, if you go down a little bit further down the road, because we do like to look out long term. On a secular basis, you have the whole AI theme in place. And so hopefully that can counteract the negatives to the increasing costs from the labor and the tariffs. But we're very fortunate that we seek out companies who have an abundance of cash flow, who can make the dividend, not requiring any sort of outside help to maneuver their balance sheets. They have all that right then and there. So.
Yeah, I think that that push and pull that exists between potential macro issues and the tailwind with AI and efficiency, I think is something that's going to take years to play out. I think it is kind of a
Yeah.
long-term um, friction or tension that's going to exist. And it's going to be interesting. Some industries are going to be stickier than others. But yeah, I think it's going to be fascinating to kind of see how it plays out. And then, like you said, quality of balance sheets and making sure cash flows are sustainable, I think is going to be critical because there's going to be lots of bumpy periods.
Yeah, because the whole macro backdrop for us has now changed, right? So, a lot different from what we saw, in the 90s and the earlier 2000s. So we're
Yeah.
having to deal with a whole new set of rules here. Watch your valuations and stick to quality.
That's yeah, and I think it is so interesting. The more exposure you get to different things and talk to business owners and really dig into companies, you can really see, I keep saying that the world around us is changing so much quicker than what we think. It really is kind of fascinating. And I think there are going to be certain companies with legacy systems that are going to be a little slower to move. And then you're going to have the really clear winners as well. But yeah, I think the environment's going to be fascinating.
I agree.
So an interesting question. We've obviously seen a lot of uncertainty in the last few weeks. We've gotten a few challenges, I would say, to the Trump administration as it relates to governance, right? How things are being done, not necessarily whether or not things can be done, but the way they're being done. We've seen the dollar weaken, we've seen the economy weaken, and we have seen valuations in some areas correct. But I'm curious, if you were to reflect now versus what your thoughts were at the beginning of the year, are you more bullish or bearish?
That's an interesting question, but I think my long-term outlook definitely still has not changed. We're still bullish long term because I still think that there's a lot of good going on out there with the AI, with the deregulation that we're seeing. Short term, yes, we've definitely been cautious. We have given a nice haircut to a lot of our technology positions where they've become overweight in the portfolios. The valuations have really been stretched and moved into a lot of those names where we find more opportunity, like the energy sector, like the healthcare sector, where those weightings in the portfolio had come down a bit. We're adding to those parts of the portfolio. So the way we look at it is that not so much that this is a negative, but it's a positive to reposition the portfolio a little bit. So, and that's something that I think that what I like to do my repositioning in September, right before everything kind of hits in October. So I think that, advisors out there should really think about using this as a period to reposition portfolios for clients, take advantage of any losses that you may have, while the market still has a nice floor underneath it in case we get into that period, like end of September, right? We're going to come up with the triple witching on the options.
Yes.
All of a sudden everybody wakes up from their summer vacations and we get that downturn in the market. Do it beforehand so that when the price is correct in October, you can start buying them back again, the portfolio.
Yeah, no, I think that's a really good point, and it is an interesting time to really look at client portfolios. As you mentioned, there's been really nice gains since the tariffs were originally announced back in April. And if you've taken gains, it's a great opportunity to look to harvest some losses and kind of make clients a little bit more tax neutral. And to your point, it's healthy as well when you get some sell-offs and the leaders. You look at NVIDIA at its peak. I know there's been so much press about this, but it was 8% of the S&P 500, which is, you'll probably help me, is that triple the energy sector as a whole? Or almost triple? I mean, it's a crazy number.
Right. It's the energy sector is 6% of the S&P 500.
So yeah, not there, about 1.5 times the energy. And I think energy at its low right after COVID was around 2.5% of the S&P 500, which was just fascinating. But it's healthy to see some of these big leaders sell off, and we have such a concentrated market. there are so many other companies, I think, that benefit from AI and some of these big trends that are just at much more attractive multiples. So I think you bring up some great points.
Yeah, the health of the market's very important. It's very, very hard to grow from a 24 times PE. Even though we're going to be starting to look at 2026 in another month or so, it's still hard to grow from that. So having that rotation is very healthy. And that's how I think people should really look at it, that this is going to be able to help us bring up that next leg in the market.
Yeah, no, I completely agree. Yeah, I mean, it'd be healthy if we have a broadening rally, and I do think
Yeah.
it's interesting when you have these big down days instead of having the whole market sell off. We are seeing some rotation. You are seeing some funds that are moving
Right.
more into value-oriented names, which is much more of a healthy type of sell-off.
Exactly.
Wonderful. Thank you so much, Catherine. Really
Thank
appreciate
you,
your
Leah.
time, and it's always a pleasure to visit with you.
Same here.